Let's now go across and invite the first management that we're bringing you today on Markets at Noon in the show, Syndicate Bank. And we decided to get the management as Poonam was reminding you all about the relaxation and the liquidity norms, the single borrower exposure limit for NBFCs and the hike in the single borrower limit for the non-infrastructure NBFCs. And here's Mr. Mrutyunjay Mahapatra, the Managing Director and CEO of Syndicate Bank on ET Now on Markets at Noon. Mr. Mahapatra, always a pleasure chatting with you. Thanks so much for joining us to help the viewers understand better the various measures announced by the RBI, another intervention on behalf of NBFCs and the housing finance companies. What is it going to mean for a bank like Syndicate? How much of an additional liquidity will get freed up and act as an advantage, if at all, for the banks to lend to NBFCs?
See, what it says is that if just for your viewers and readers to understand how it operates, see, the banks have to maintain a basic level of liquidity in terms of liquid assets, and if this is to be achieved in two parts. First, as a core part coming out of the SLR portion of the bank's holdings. From that, earlier, initially when it was formulated, 11% was given, then there is additional 2%, then there is additional 2%, so like that the top-up is happening. That means the top-up portion of the liquidity requirement can be the only determining factor which will impair the ability of the banks to lend to any particular sector, because it has to be kept in liquid assets, it cannot be kept in loan assets. Now what the RBI has told is that to an extent of additional 0.5% up to December 31st, these can be carved out of the existing SLR holdings. As a result, what will happen is that the banks can free up to 0.5% of their holding and can give it as a loan to the NBFC sector, because only NBFC assets that have been created during the period, those will be reckoned for this 0.5%. So as a result, literally as per the scheme, 0.5% of the liquidity can be used for this.
Now, what we understand from NBFCs and experts is there's a huge trust deficit. Is this going to change that?
See, I think you articulated it nicely for me to give the answer. The first thing, as you told, whether there is a dearth of liquidity, the answer clearly, as of now, no. Liquidity is not a big problem in the market. Whether there was a trust deficit, there is definitely a mixture of trust deficit plus market condition, because as we are seeing in the market, the NBFC sector by the bank is priced at a level which is riskier than what the external rating agencies are giving. For example, AAA rated entities are being priced at a level of, let us say, AA or even a single A, depending on their exposure level. So the confusion that is there in the market regarding the stability, at least the short-term stability of the NBFC sector, where because of disclosure requirement, because of back-ended convergence of various group companies, because asset liability mismatch, because the ability to disclose it fully, there are definitely confusion amongst the lenders to the extent of understanding the risks completely. So as a result, the pricing has gone up. In fact, AAA rated companies have reported that there is a 30 to 50 basis point increase in their borrowing cost, even for AAA rated companies. So accordingly, we can consider that for others there is an increase between 30 basis point to 75 basis points in their borrowing cost over the last period of 2 to 3 months.
If you look at what the regulator has been doing, RBI has eased liquidity so far. NHB has also raised the refinancing limit. SBI has hiked the amount that they are going to buy from NBFCs in terms from assets. Do you think they are meaningful at this point of time?
As of now, to your question that whether these are enough or not, I think it is too early to take a call. You cannot decide whether these are enough or these are more than enough or these are less than enough. What we are discovering today is that we are dissecting, analyzing and prescribing solutions as the things are unfolding. Because we are on the one hand, we are seeing that housing finance companies are probably in a bit of strain. Sometimes we are finding that infrastructure NBFCs are under a bit of strain. So one after another, we are coming to terms with various things which are required to be done in the current atmosphere. So liquidity has been always in any crisis situation, whether you take it the Lehman crisis or whether you take it the Indian crisis which we have seen in many things. Liquidity is the first medicine that is given by regulators and leading players to keep up the market, because otherwise market will go into a spiral. So that is what also happening in this situation. Liquidity is the first thing that we need to inject in order to keep the market going. Why?
Let's talk about the real estate space as well, the sort of concerns that you're seeing in terms of real estate, LAP, construction finance, SMEs. Are these, leading to a slowdown in various sectors?
No, my view is that, data doesn't support that. Yes, construction sector, because the RIT has come in and there are additional regulatory and oversight things. Now, even Supreme Court is telling timely delivery, so that those kind of real estate companies which were mobilizing public money and investing in new projects before they complete an older project, I think those kind of accountability and responsiveness is there to stay. So the financial models which the construction sector or the real estate sector were following, where old money was being used preemptively to create new projects, probably those things we will see a slowdown. But otherwise there is still the housing penetration or owned house penetration as compared to many developed markets is still very, very low. So I believe there is an upside to it, but with bigger kind of limits, bigger kind of boundaries or benchmarks being set for them. And for the other side, the outlook is that the NBFC sector, will find newer ways of adjusting with the real situation, and that is where things are moving.
Okay, but Mr. Mahapatra, specifically for your bank, Syndicate Bank, do you see a slowdown in NBFCs to be an opportunity for lending? Like a bank like yours, what's the kind of credit growth you're anticipating, post this entire development, post this massive scare that has come around thanks to NBFCs and housing finance companies?
See, we have a fairly large depth of relationship in the NBFC sector. Many large NBFCs keep on banking with us. And today our NBFC exposure is roughly around 9.5% of the bank's loan book. And we have most well-rated and large NBFCs with us. So this is an opportunity definitely if the NBFC sector turns up. But internally we are keeping a watch on the situation because our database is quite rich. And we are trying to do analytics as to how the market is kind of responding to what is happening to the NBFC sector. So selectively we can grow, and grow selectively is our outlook for this sector.
And Mr. Mahapatra, please do share, are there any updates on your capital needs, any kind of capital raising we may see in the rest of this financial year?
See, capital, as per the current capital plan, we have to raise as per the agreement with the government through different own methods outside of government's own subscription to our capital. We have to raise around our own about 500 crores. We are well on track towards that.